Dividend stocks. These are shares of companies that regularly distribute part of their profits to shareholders. The idea dates back to the early days of stock markets, when investors bought pieces of businesses not only to benefit from growth, but also to receive a portion of earnings. What makes dividend stocks distinctive is their ability to generate periodic income without selling the asset itself. Large and stable companies often follow this model, especially those in sectors like utilities, banking, and consumer goods. For many investors, dividends represent a steady flow of money that can be reinvested or used as income.
Rental real estate. This type of asset produces income by allowing others to use a property in exchange for regular payments. The concept has existed for centuries, long before modern financial markets, as landowners rented homes, farmland, and buildings. In modern cities, apartments, houses, and commercial spaces serve the same purpose. The value of rental real estate lies in two layers: the monthly rent and the long-term appreciation of the property itself. Because of this combination, it has historically been considered one of the most reliable ways to generate ongoing income.
Bonds. Bonds represent loans made by investors to governments or companies. Instead of owning part of a business, the investor becomes a creditor who receives interest over time. Governments began issuing bonds centuries ago to finance wars, infrastructure, and public projects. Today, corporations also use them to raise capital for expansion. What distinguishes bonds from many other assets is their structured payment schedule. Interest payments arrive at predictable intervals, making them attractive for investors who prioritize stability and income.
Real estate investment trusts. Often called REITs, these are companies that own or finance income-producing properties. The structure was introduced in the United States in the 1960s to allow ordinary investors to participate in large real estate projects without directly buying buildings. REITs collect rent from offices, shopping centers, warehouses, and apartments, then distribute most of that income to shareholders. Their importance comes from accessibility. Instead of managing properties personally, an investor can receive income from large portfolios of real estate through a single investment.
Royalties. Royalties are payments made for the use of intellectual or creative property. Musicians, authors, inventors, and designers have used this model for decades. When a song is played, a book is sold, or a patented invention is used, the creator receives a percentage of the revenue. The asset in this case is not physical, but intellectual. What makes royalties unique is their ability to generate income repeatedly from work that may have been created long ago. A song recorded decades earlier, for example, can still produce revenue each time it is streamed. Businesses. Owning a business is one of the oldest forms of income-producing assets. Merchants, craftsmen, and traders have relied on this model throughout history. When a business generates profit, the owner benefits directly from the activity. The income may come from selling products, providing services, or operating systems that customers rely on daily. Unlike passive financial instruments, businesses often require active management, but they also offer the potential for higher returns because the owner controls the operations and growth strategy. Peer-to-peer lending. This modern asset emerged with the growth of online financial platforms. Instead of borrowing from banks, individuals or small businesses receive loans directly from investors through digital marketplaces. In return, the investor earns interest on the money lent. The structure mirrors traditional lending, but removes some of the institutional layers. Peer-to-peer lending became more common in the early 2000s as financial technology expanded access to credit and investment opportunities. Digital products. These assets generate income through the sale or licensing of digital creations, such as online courses, software, design templates, and educational materials.
With the expansion of the internet economy, creators can distribute products globally without manufacturing physical goods. Once the product is built, it can often be sold repeatedly with minimal additional cost. This scalability is what makes digital products distinctive among modern income-generating assets.
Farmland. Agricultural land produces income by growing crops or raising livestock. Investors may operate the land themselves or lease it to farmers who pay for its use. Throughout history, farmland has been a fundamental economic asset because it produces essential resources like food and raw materials. Its value is tied not only to the land itself, but also to the productivity it enables. Because global demand for food remains constant, farmland has long been viewed as a stable and tangible source of income. Infrastructure investments. These assets involve funding large public systems such as highways, airports, energy grids, and communication networks. Governments and private investors often work together to build and maintain these structures. Income is generated through fees, tolls, or long-term service contracts. Infrastructure investments gained popularity in the late 20th century as countries sought private capital to support large projects. Their significance lies in their long lifespan and the steady demand for the services they provide.